Dear friends of Grey Rhino, I'm very happy to be seeing y'all once again.
Hi, Gary. Thank you very much for the time that we can ask you questions about what is happening with the economy lately. I think it has been quite a while since we are asking you about that. How are you?
Okay, I've been very good. A bit more busy recently.
Okay, thanks. Thanks for sharing. I think busy is also good, right? Gary, I just wanted to ask you, right? May's inflation data in US show that inflation is up 5% year on year, which is actually above the expectation of 4.7%. However, the stock market reacted positively to the news. Why is that so? Maybe you can share with us.
Yeah, I think something interesting. First, inflation has been a topic I've been talking quite a lot this year, and rightfully so, because as I said, inflation could potentially be a game changer for asset prices. Okay, so I've been looking at this data as well. Yeah. And so I think it's an interesting thing. Let me share. I prepared some slides as well, so to help you understand. Okay, so this is a slide you talk about. Yeah, so it's 5%. You can see, it's big spike up from last year. So why did it not cause a panic? Yeah, in fact, the stock prices went up. Okay, so let's look at the first reason. It's called the base effect. Okay, because last time this year was the midst of the COVID. So May 2020 was the midst of the COVID. As you can see, inflation decreased a lot last year. Okay, so if you look at the red line is if we don't account for the large drop last year. In fact, the inflation would have only gone up 3.5% instead of 5%. So 1.5% is due to this thing called base effect, which is due to last year's decline. Okay, so that's one reason. And I think the more important reason is the second one, which is we got to look at the components. What part of the CPI, the inflation, that causes the increase? Yeah, because generally now the Fed's view is this is transitory. Yeah, if this is short term, then when this passes, they're still going to keep monetary policy loose. They're still going to keep rates low, which will still be supportive of asset prices. Yeah. However, if this is more long drawn, then that's where the Fed may have to act. They may have to then raise rates faster, and reduce money printing. And from the data in May, I think it's kind of vindicated people's view of the Fed, that they think that because of the components, hence this inflation is likely to be transitory. Because if you look at it, I rank it in descending order. Yeah, things like car, trucks, rental, used car prices, these are the parts that's been causing a big increase in inflation. And these are largely due to pent-up demand, because because of the supply shortages. Yeah, because now there's shortages of chips to make cars, so the new cars can't be produced, and yet people want to travel, and they can't travel overseas. So what they do is they need to take domestic flight. They need to buy cars to travel, rent cars to travel. But if you look at the rest, like shelter, food, it actually hasn't increased that much. Yeah, and hence this gives people a feel that, I think this inflation is going to be more transitory, and hence rates will be kept low, and hence asset prices will still be supported. Yeah, and I think that's the reason why that the market went up despite inflation data was more than expected.
I understand. Do you think that reaction is warranted, Kerry, or actually should investors be concerned?
Good question, Adi. Yeah, in fact, this is really a question I've been already looking into after the inflation data. Okay, let me share with you. I think first let's take a look what is the CPI data first. Okay, so this is the makeup of the CPI data, which about 40%, the large majority is housing, and then followed by food and beverages and transportation. So let's look at the biggest component first, housing. Okay, how is the housing inflation determined? It's determined by this thing called owner's equivalent rent, which means is, for example, if you're a homeowner, so I'll let you take a survey. Adi, how much do you think your home is, if it's converted to rent? Like if you rent this place, how much do you think you'll pay? And then you basically fill in that number. But you can imagine, right, for someone who has been staying at their home for many years, they're probably quite oblivious. What is the current housing market out there? What's the current rental market out there? until they start talking to people and get themselves informed. So it's going to be quite lagging. So if you look at the black line, which is the housing price, in fact, housing price has spiked up in US. It's gone up more than 10%. So the truth is, house prices has gone up. There has been housing shortages, vacancy has been going down, and yet it's still not reflected in the housing inflation yet. My view is, I think this will be shown in the inflation data as the homeowner starts to realize their home prices has actually appreciated. Secondly, I'd like to talk about minimum wages and the dishing out bonuses by companies. Because currently, the US the US government is giving out a lot of stimulus checks, and hence people get paid, by just staying at home. So then, to entice them to go and work, the companies need to pay them more. So if you look at on the left side, some of these companies like Bank of America, Amazon, McDonald's has been offering bonuses to entice workers to accept jobs. On the right side, McDonald's, they have raised wages by 10%. And I think wages are quite sticky. Just put yourself in a position as a business owner, Adi. Let's say if you give your employee a pay raise of 10%, is it easy the year after that to tell them, sorry, I think that was just a fluke. I need to reduce your payback by 10%.
I think it's very difficult, not easy.
Yeah, it's very sticky. Because so it's very hard to do. And hence, I think once wages are raised, it's going to be quite sticky. It's not going to go back once the stimulus checks has stopped. Okay. So that's the second reason. That I think inflation will be more long drawn than what the Fed thinks. Thirdly, I think this is probably the most important, is we got to realize there has been a change in the government. But the last 8 years under Donald Trump, I think what it's quite clear that the Donald Trump's policy is wanting to benefit the corporations and the rich. Okay, and when wealth are stuck at the rich, in fact, it doesn't cause inflation. Because you can just imagine if Bill Gates today, given the wealth he has, he still eat 3 meals a day, I believe. He still take one car at one time. Okay, so he doesn't cause increase in price of the basic necessity. However, if today you take the 1 billion from Bill Gates and you give to 1 million people $1,000 each, what's going to happen? They're going to consume. In terms of the number of meals, the transportation demand, immediately going to spike up. And what's happening is the Democrats under Joe Biden, that's what they're trying to do. To try, and that's his election promise anyway, to benefit the lower income, the middle income, by taxing the rich. So currently he has already have 1.99 trillion fiscal stimulus that's passed, and he's now putting forth a 2 trillion infrastructure plan, and also a 6 trillion budget for 2022. All these are big spending. That means money is going to be printed and it's going to flow down to the lower and middle income. And I think that will raise what you call the velocity of money, because consumption is going to go up. And hence there's a real risk that inflation is going to be more long drawn. And that's my view. I think inflation is going to be more long drawn than what the Fed thinks of as transitory. So that's what I think.
Thanks a lot for sharing with us your point of view on inflation. I think it's very extensive. So now come to a very important point for every one of us. What advice would you give to our friends who are watching this video now with regards to the investment portfolio that they are having?
Sure, Adi. So as I said, my central case is inflation is going to be more long drawn. However, I don't think we're going to go back to the 1970s era where inflation was double digits. Why? Because I still think we have the underlying forces still kind of depress inflation. For example, disruption, technological advancements. All this has the effect of improving productivity. Okay. Secondly, there's been a declining in population in the wealthy nations because of low fertility, and hence when the population decreases, it reduces aggregate demand, and that again is I would say force that is lowering down inflation. So that's my central case. How should we then position our portfolio in view of these Firstly, I would caution against making major changes to asset allocation. That means don't go and sell all your stocks to keep cash, because inflation seems to be rising. Okay. So I think you can largely keep your asset allocation the same, unless you're having 100% equities. Then I think you may want to reduce part of it. If you're having kind of like 50-60% of your assets in equities, I think that's fine. But what we can do is make tweaks within the allocation. For example, within equities, there are some equities that are more at risk than the others. Some of those are those companies where their earnings are very far out. That means they could be not earning money. For example, like the Tesla, the NIO, not making money. Or they are making money, but their price earnings ratio, their valuation based on current earnings are very high. That means they're priced a lot based on their future earnings. And these are the companies that will be most affected when interest rate rises. Okay, the second type are the companies that are having largely they're not increasing their earnings. Their earnings are fixed. And hence they are priced based on their dividends. For example, they give a 5% dividend yield. In a low 0% interest world, a 5% dividend yield looks attractive. But however, if interest rate goes up to 3%, a 5% dividend will no longer be as attractive. The dividend rate needs to go up to say 7-8%. But these companies, because their earnings are fixed, they can't give more dividends. How to increase dividend yield? The only way is if the share price drop. And hence this could happen to this type of companies. So I'll say you may want to reduce or remove such companies in your portfolio. Second class of assets, which I would say to avoid since late last year or early this year, which is the long duration, safe government bonds, like the US Treasuries, because they pay you, the return is very low. They pay you 1%, 2%. But when prices rise, they can get punished. So far, like the 30 years Treasury bonds has declined like 20-30%. And this is a big drop for supposedly a safe asset class. So I say these assets I would say avoid at this moment. So generally I would say don't make big changes to the main asset allocation, but make tweaks within there. So that's what I would do to my portfolio, and that's what I would advise our friends listening in as well.
Thank you very much, Kay, for sharing your wisdom, and also especially the reminder to us to pay full attention about what is happening with the inflation, economy, and even making some adjustment, maybe, if possible, in our investment portfolio as well. And thank you very much for your time today. Hopefully, we can see you again soon to really learn from you as well about how to make our wealth growing and also to be beneficial for people around us. Thank you very much, KV. Wish you a healthy life as well.
Thank you very much. You too. Take care.
Take care. Bye-bye.
Bye. Bye.
If you'd like to be listening regularly to the Grey Rhino YouTube to gain more financial knowledge and also investment wisdom, do subscribe below to the Grey Rhino YouTube channel and remember to turn on your notification.